Now, Bill Lee, Chief Economist at the Milken Institute. Bill, great to catch up. What did you make of what Powell had to say yesterday? He is clearly waiting for inflation to show up. If I was to take anything away from yesterday, it's the fact that it did sound as if Powell was slightly more concerned about the inflation that is going to arrive from tariffs. And now we've got to fold in the prospect of higher energy costs as well. Is inflation the biggest threat?
Well, I can almost see Chair Powell biting his tongue and trying to avoid the standard economist reply, which is tariffs only jump the price level. They don't raise inflation. And he doesn't want to say transitory. So he's I think, just trying to give the impression that we are concerned. We may be wrong, but we think that we don't need to do much. But we're going to let the data speak for us. Because the data that has spoken so far has shown that the U.S. economy really is doing quite well. The cutback in in retail sales is the consumer just showing that they bought up a lot of stuff earlier in anticipation of price increases. And the slowdown has been in the big items like appliances and consumer durables and vehicles. But the retail control, which is the other more regular elements of consumer spending that go into GDP, that was actually quite strong. So I think what Chair Powell is trying to give a sense of is we are aware of the risks out there, and we're not going to say anything until the data speak. And the survey data, the soft data, has shown that the world is concerned about the impact of tariffs. They may raise prices, but again, we'll see by how much and for how long.
How are you thinking about the potential for an oil shock as well? Because that's the other story that we've now got to fold in as well.
You know, Guy, one of the things about the oil market is that it really is reacting very differently to geopolitical risks than in the past. If you find that there's an all-out war in the Middle East, prices would have spiked easily over $100 a barrel. Right now, we see them rising by from $65 to maybe $75, right? $10 increase, a very contained, moderate increase. And one of the things that you have to keep in mind is that now there's a big amount of reserves that are ready to come online. And a lot of it comes from the United States, but a lot of it is from the OPEC members. So right now, in some sense, the world is well supplied by oil, and the facilities in Iran is really not that much.
Yeah, but you could argue that some of those reserves are trapped behind the behind the Straits of Hormuz in the Gulf, and were we to see a conflict, maybe that wouldn't be available, Bill. And so there's just huge amounts of uncertainty. So is the Fed just right to wait? Is that the right course of action at the moment? Because the president doesn't see it that way. The president wants to see significant cuts.
The president is a construction man, and there's no construction man you will ever meet who will not say that rates should be lower. So I think that bias in wanting to lower rates is in some ways a sense of frustration that his policies for restructuring the United States are really not getting put in place fast enough. The bill that's going through Congress right now that's supposed to lower taxes and ensure that the U.S. economy will have lower taxes and lower the cost of production that way is may be passing and may not be passing. The smaller government has really, the dovish efforts have not really paid off, and we have yet to see the deregulatory efforts on the part of the president. So the big policy packages are yet to be put in line. And to me, that's where a huge amount of policy uncertainty is, not so much with the tariffs, because the tariffs are really there to try to incentivize more people to invest in the United States, to partner with the United States.
Let's say the president changed the Fed chair tomorrow, and it's possible that we get an announcement on who the next Fed chair will be fairly soon. Let's say the market looks at that next Fed chair and goes, they're going to cut by 100 basis points, or they're going to cut by 50 basis points, or they're going to cut. What will be the impact of a Fed that cut by, say, 50 basis points or 100 basis points at this point? How would that? What do you think the implications of that would be?
Well, Guy, I think the surprise might be that if we really have a dove appointed as Fed chair, you're going to see maybe lower rates on the short end, but the long rate's going to start to jump. Right now, inflation expectations are pretty well contained. But if you get someone who's a well-known dove in that position, someone who's going to lower rates and keep them low as much as possible, regardless where the economy is going, then you'll find that the inflation expectations start to take off again. Right now, they're well contained, and 5-year break-evens are about 2.25. They actually are down from 2.5 of earlier. But once that picks up, with long rates are going to go up, and that'll really backfire and make the deficit situation in the United States even much worse situation to finance.
So the biggest risk to inflation right now in the United States is lower rates.
I think the biggest risk is appointing a dove that will unanchor inflation expectations. Right now, I think Chair Powell is doing the right thing to say we're going to wait until the data speak, and then we'll act accordingly. If the labor market falls apart, we'll lower rates. If inflation actually does take off and goes beyond that price level jump that we're anticipating, then we're going to have to keep rates where they are, or perhaps even raise them. Now, he won't worry. He didn't say raise them, but he certainly said to maintain current tight conditions.
Bill, great to catch up. Thanks for joining us this holiday.